Mike, let's kick off with you. Mike Muller, of course, head of Vitol in Asia. I'm sure he'll be rushing back there in the next few days to get in time for APEC, which is only a few days away now. Mike, since we broke away 2 months ago for the summer holidays, it felt and it seemed and it was $80 Brent was a floor of this oil market in 2024. In our absence, it feels that we come back and now it is a ceiling. Your thoughts on that and what has changed in the 2 months that we've been away at the beach?
Well, speak for yourself here, Sean. But yes, hello from the UK. I'm here for some days of business before APEC starts this time next week, indeed. Yeah, I mean, that pie chart, that poll you just showed of your audience showing consensus around 80, 85, 90, 95 does indeed look high now. But I think it's going quite far to say 80 is now a ceiling. I mean, we spent much of last week at or around the 80 mark and had a slightly weaker close on the Friday. But bear in mind, of course, Friday was expiry, so don't look too much at the front month. That is not really representative because the expiring contract tends to be a function of the moving average of the final day. For oil markets, look at the backwardation. There is still a very, very strong signal from the markets that demand at the very front end for crude oil is strong, and I emphasize for crude oil. So you now look at the front spread for Brent, looking at the November-December spread, because as of tomorrow, Monday, September 2nd, front month contract is no longer October, it is November. You've got 75 cents backwardation, and the month beyond, you've got 55 cents backwardation. And in WTI, the backwardation is even steeper. You have 70, 80, and at the front, at sometimes 90 cents backwardation. The markets are less strong in refined products. And of course, that is generally your leading indicator. That's where the demand actually occurs. And you've got quite interesting situation where for refined products, you don't have that same degree of backwardation. Indeed, in some cases, you have contango. So mixed messages there. But the front of the crude oil market, which is where supply can at times be managed by OPEC Plus, is still at this time healthy. But I think it would be going too far to say it is as strong as when you showed that poll, that pie chart, where the consensus ranged from 80 up to $95. And indeed, one of the larger advisory investment banks revised their outlook for the balance of this year from a range that they had at 75 to 90 range to now 70 to 85 range. So I think people are guided by that, and whether the market will go all the way down to 70 remains to be seen, because there are good reasons at the front end of the market why supply remains tight. First and foremost, of course, the disruptions of supply in Libya, which have been front of mind for the past 2 weeks, with outages towards the end of last week reaching levels that are of concern. But if you have poor product markets and strong crude markets, and crude gets stronger and people continue to be concerned about demand in places like China at the front, you end up with refining margins getting compressed. And that has led some people to making statements that they're looking to trim refining margins, so to trim runs. And in such a scenario, if prompt oil goes missing from somewhere like Libya, markets are less concerned about rearranging their schedules. They simply run down inventory and then plan to run a little slower in future on the margin where there may be no margin. So that's the brave face that the refining industry is going to put on any outages and any absence of supply from a source such as Libya.
The other thing that seemed to change, or at least coalesce from the point of view of going into the summer holidays, the diversion of views on the global oil demand growth for 2024. There was ranges, but generally ranges that were more 1.5 to 2 in terms of obviously OPEC at the top end. But we sort of come through the summer with a consensus being more around 1 now on the lower end of the sort of general views going into the summer. Rystad Energy held a session last week where they pointed that the global demand growth only being around 1 million barrels a day for 2024. That to me sounds like $80 as a ceiling, not a floor.
Yes, but not entirely correct with those numbers. It is true that over the summer, just about everyone has revised downwards their demand projections for full year 24 and, of course, 25 on 24 demand growth year on year, to a point where the growth numbers in demand more or less match supply of non-OPEC crude growth as well. Handing the challenge to OPEC Plus to manage the balance in that context, meaning there's a perception that there's going to be less room for OPEC to grow production, to put production back on the market again, as at some point a few months ago, people thought was absolutely going to be necessary. So what was a rather bullish outlook for crude in the back half of this year, which we are seeing in crude, helped, of course, by the Libya story and things like that, has become a softer general outlook, that's for certain. But no, the demand has not been revised from 1.5 to 2 down to 1.0. That would be a 500 to 1 million barrel day demand downward revision for calendar year 2024, which is more than half elapsed. Impossible, right? What I think we need to distinguish is that there are two sets of numbers that you need to look at. One is total hydrocarbon growth in demand, and the other one is demand for a refined product. The difference being NGLs, gas liquids that come from gas production, which has become an increasingly large segment of total supply into petrochemicals, often a completely forgotten segment of trade, right? So the 1 million barrel day figures, in my mind, most likely exclude NGLs. But they do form part of the supply chain because they do go into petrochemicals and also into gasoline blending at times. So I think the movement in the movement in demand projections from July to now is probably down a couple of 100,000 barrels a day at most. Yes, in most people's balances. That's still very, very significant. That really is quite a lot, because that's, just call it roughly 3 VLCCs a month of less demand from the Middle East Gulf to places like China. And of course, fingers are pointing at China as being the place where most of the downward revision has occurred. The industrial statistics from China are not shabby, but they've not been encouraging either. And if you look at various indices around China, it's not just oil and energy. There is little reason for hope that those will revive. People point a lot to electrification, substitution of diesel demand with LNG for trucking, and also lower industrial demand in general. And if you put all those together, you then add to it the very latest signal from China, where the official export quotas for refined products for the balance of this year came in at a lower level than were expected, tells you that China intends to run its refineries a little less hard. So that's taken the wind out of the sails of the market somewhat and countered the shortage of Libyan crude.
Mike, the other big development looking forward now, as we look to the month ahead, is obviously OPEC, the 8 countries within OPEC that have announced they're going to start increasing production from October 1st, which now is 1 month away. And I'm wondering, just from a start point on that conversation, has the market bedded in that as happening, or is the market bedded in that they're going to abandon that?
Yes, I think that is indeed the big debate, and it's going to play out over the coming weeks and in the week coming into APEC. I mean, this is the time of year where, for many, not for India, because India's cycle runs April to March, but for most others, you sign up for long-term committed crude, including term contracts from OPEC suppliers, and you take a view of your relative economics and your outlook for refining margins, and the official selling prices that are going to be announced in the coming days, probably the back end of this coming week, for Asian refiners in particular, are going to serve as a guide as to whether that policy is one of supply going missing or supply to market being increased. Yes, all eyes are going to be on those official selling prices, and then on the acceptances of nominations for the forthcoming operational month, which is October. Of course, Asia's already trading November barrels. So I'll give you the diplomatic answer. I mean, the market should be reflecting what's been announced, with an overlay of messaging of those people that are close to decision makers in OPEC Plus and Saudi in particular, in terms of what the hints are that are forthcoming. There is a school of thought that there is less room to put supply on the market than there was before, and I think we'll see that playing out if we see lower prices, or if we see a disappearance of backwardation. But as I said at the very start, the front end of the crude oil market remains quite snug, quite healthy.
I mean, Mike, just to follow up on that, just technically at this point, I mean, 1 month out from increases starting, that's kind of no, the ship sailed on that, but at least for the first month, 180,000 barrels. This is a month-to-month increase, as was announced earlier this year in great detail. At least that first month can't be turned off now, surely.
Indeed, and that's why you're also seeing a lot of talk about those countries that had somewhat overproduced, reining in that overproduction. There's been a lot of mention of Iraq of late, Kazakhstan, and various others. So that rebalancing is also occurring behind the scenes, and we're not getting any official statements on it, but there's a lot of talk about production being corrected in order to rectify the balances there also. I think we might end up somewhere in the middle. It's very difficult to say, but the proof's in the pudding when you see the acceptances of nominations, which is not a publicly available set of information, but you'll get feedback from major swing refiners in Asia, be it the Chinese, the Koreans, some of whom have been talking about wishing to cut runs. They may just nominate a little bit less in October, and therefore there may be no need for OPEC to send a message. They may just, the major producers may just supply a little bit less than they had intended to, and that figure you mentioned may not come to market in its entirety.
Just looking forward into the fourth quarter now, as we go into this sort of post-summer phase of the year, the fourth quarter cycle, what comes with that? I mean, typically a lot of ramping up of products for the winter and so forth. What kind of a demand push does that give us, or not?
You get the typical seasonal upswing in Asia, less so in the West. In fact, the opposite in the West, where there's stronger demand and therefore there should be strong refining runs. But it's all a question of inventories and margins. And as I said before, margins are teetering at the point where they've just about evaded real run cut territory so far. Held up, by the way, by reasonably buoyant outlook in the petrochemical side of things, and also a slight bounce in the fuel oil, in the VLSFO in particular. But yes, Asia tends to pull, so you'll get Japanese refiners who've had a big spate of refinery upsets this year, nominating harder, nominating more crude to run to satisfy demand in that time of year. And on the inventory side, I guess you're also looking at how much discretionary diesel has been burned to cope with some of these ridiculous heat waves that we've seen. I mean, Sichuan province, 2 weeks solid at 40 degrees plus. Shanghai had a 10-day streak of around 40-degree temperatures. And if you translate that into less efficient energy supply chain markets around Asia, you've seen a lot of diesel burnt in gensets just to keep air conditioning on and things like that. So then you've had probably the heaviest jet fuel demand season in a very long time, possibly ever, in terms of summer holiday consumption. That's more of a Western Hemisphere thing. So the market has had some pockets of decent health. But I'd come back to chemicals. I mean, in per ton terms, naphtha is obviously a lighter product, 9 barrel ton factor versus diesel at 7.5 barrel ton factor. But naphtha has been a laggard of late. But I think you'll find that in China now, naphtha is pricing at a level that is at or above diesel. And that's something that's unthinkable in international markets. But it tells you that there is strength of demand in the petrochemical sector. And people are going as far as to say, how do we get to higher naphtha yields to make more petrochemicals in China, when that's not on anybody else's radar just yet.
Mike, just to follow up on that, I mean, clearly we're getting to the end of the year. China's had obviously a sluggish along year, sort of with some expectation that, they'll finally get the bazooka stimulus going, or they'll turn the corner on this thing. Or do you expect any of those things still to happen this year, or are we just sort of sluggish along, all more or less okay, but no real game-changing moments?
I think on China specifically, there's been a disappointment on foreign direct investment, and the government's made up for that with quite a substantive stimulus package to counter that. And what's happened in the past is Q4 has always been the most interesting month in terms of Chinese policy. So we did see 2 years ago at this time, or a bit later in the year, a surprise addition of export quotas, which had the Chinese refining system running harder, and then taking some of the supply of prompt Russia, for example, off the market at that particular time. And that was to stimulate, but also margins were positive, and there's some sense that it was to do with hitting some GDP targets as well. So China can surprise on that front. The other market that's pretty strong, stronger than one would have expected when you ended this series in July, was the LNG market. we've seen a number of outages, and what's been relatively robust demand manifested itself in South Asian countries that are price sensitive, tendering to purchase LNG at prices that 5-6 months ago we would have said they can't afford. So that's also a relatively positive signal, which might do away with displacement of diesel demand into LNG, or on ships, fuel demand moving to LNG for bunkering, as LNG prices remain high, should oil prices fade a little from here. And then, of course, you still have, we must remind ourselves, the burning ship in the Gulf of Aden off Hodeidah, which the Houthis now are apparently trying to salvage. But I think they lost quite a few friends in the, let's call it, outrage over Gaza world, over that incident where they went and quite deliberately planted mines on a ship after the crew had dropped anchor and abandoned the blazing ship, in order to that's not what people expect people to do in solidarity with the situation in Gaza.
Yeah, it is a very strange circumstance where they're now the ones looking to salvage the ship.
What I was trying to make is that in many people's minds, that image has a lot more people than before not wishing to transit that particular passage. So it leaves more oil and water, and it serves to support markets if oil has to travel further distances, right?